In the summer of 1998, the most celebrated hedge fund in Wall Street history was days away from destroying the global financial system. Not a rogue trader, not a Ponzi scheme, not outright fraud, just mathematics. Brilliant Nobel Prize-winning mathematics applied with catastrophic arrogance. This is the story of long-term capital management and how the smartest people in the world nearly ended modern finance as we know it. John Meriwether had already survived one scandal. In 1991, he was forced to resign from Salomon Brothers after a treasury bond bidding scandal involving one of his traders. Most careers would have ended there. Meriwether was not most people. In 1994, he founded long-term capital management known as LTCM in Greenwich, Connecticut. He recruited the most impressive team ever assembled in finance. Myron Scholes and Robert Merton, who would win the Nobel Prize in Economics in 1997, joined as partners. Former Federal Reserve Vice Chairman David Mullins joined. Dozens of PhDs in mathematics, physics and economics signed on. The pitch to investors was simple. These were the smartest people alive, armed with mathematical models that could identify and exploit tiny pricing inefficiencies in global bond markets. The minimum investment was $10 million. Investors lined up: Merrill Lynch, Bear Stearns, banks from Europe and Asia, sovereign wealth funds, even the Bank of Italy invested. By 1997, LTCM had $125 billion in assets. But that number understates the true scale of the bet. Through derivatives and leverage, LTCM controlled positions worth over $1 trillion. $1 trillion controlled by a fund with only $7 billion in actual investor equity. For every $1 of real money, LTCM was betting $25 to $30 of borrowed money. The models said this was safe. The models were about to be proven catastrophically wrong. LTCM made money by identifying situations where similar securities were priced differently and betting they would converge. A bond in one market might be priced slightly differently than an equivalent bond in another market. LTCM would buy the cheap one and sell the expensive one, waiting for the prices to come together. These convergence trades made tiny profits on each transaction, but multiplied across hundreds of billions in positions. The profits were enormous. In 1995, LTCM returned 43%. In 1996, 41%. In 1997, 27%. The models worked. The Nobel Prize winners had cracked the market. And then Russia happened. In August 1998, Russia defaulted on its government debt and devalued the ruble. This was not in the models. When Russia defaulted, panicking investors around the world did exactly the opposite of what LTCM needed them to do. Instead of prices converging as the models predicted, prices diverged. The bonds LTCM had bet would rise fell. The bonds they had bet would fall rose. Every single trade moved against them simultaneously. In normal markets, this was statistically impossible. In a global panic, it happened. In August 1998 alone, LTCM lost $1.9 billion. In the first 3 weeks of September, they lost another $3 billion. A fund that had started the year with $7 billion in equity was down to $600 million. But they still controlled $1 trillion in positions. If LTCM collapsed and was forced to sell everything at once, the fire sale would devastate every major bank in the world. Bear Stearns, Merrill Lynch, Goldman Sachs, Morgan Stanley, Deutsche Bank, Barclays, all of them had lent LTCM money. All of them had trades with LTCM on the other side. A sudden collapse would trigger a cascade of losses that could freeze credit markets globally. The Federal Reserve Bank of New York understood this. President William McDonough called an emergency meeting of the major banks. On September 23, 1998, the CEOs and presidents of 14 major financial institutions gathered in Lower Manhattan. The message was simple: LTCM was going to fail, and if it failed in an uncontrolled way, all of them would suffer catastrophic losses. The banks agreed to inject $3.6 billion into LTCM in exchange for 90% of the fund. The existing investors would keep only 10% of what had once been worth billions. It was not a government bailout, no taxpayer money was used. but it was organised and pressured by the Federal Reserve, which was as close to a government rescue as it could be without congressional approval. John Meriwether and his Nobel Prize-winning partners had been saved from complete annihilation, but at the cost of their fund and their reputations. The positions were slowly unwound over the following months. Most of the convergence trades that LTCM had made eventually did converge, just as the models predicted. The markets had moved against them temporarily, but the mathematics had been correct. They just ran out of time and money before the markets came back to where the models said they should be. This is perhaps the most important lesson of the LTCM disaster. Being right about the direction of a trade means nothing if you cannot survive long enough for the market to agree with you. Leverage kills. When you borrow $30 for every dollar you own, a 3% move against you wipes you out entirely. The Nobel Prize winners knew this. The mathematics proved it. They bet their fund and nearly bet the global economy that they could manage the risk. They were wrong not about the direction of the trades, but about their ability to survive until the trades worked out. After LTCM, regulators promised to increase oversight of hedge funds and the leverage they could use. Those promises were largely forgotten within a few years. By 2008, investment banks were using leverage ratios similar to or higher than what LTCM had used, with the same catastrophic results. The specific names changed, the mathematical models evolved, but the fundamental arrogance was the belief that brilliant people with sophisticated models could safely control risks that would destroy anyone else. The arrogance never went away. It never does. The smartest people in the room are often the most dangerous, because they are the most convinced they cannot be wrong. John Meriwether went on to start 2 more hedge funds after LTCM. Both failed. Myron Scholes started his own fund. It also struggled. The lessons of LTCM were not learned even by the people who lived through them. That should terrify you, because right now, somewhere in Greenwich or Manhattan or London or Singapore, a team of brilliant mathematicians with Nobel Prizes and PhDs is running models that say their positions are safe, their leverage is manageable, their risk is controlled. They have thought of everything. They are wrong. They just do not know it yet.